You're choosing based on fees right now. You think 0 beats 0.03. You're wrong. Not because the math is wrong, because you won't make it far enough for the math to matter. Something happens after the initial excitement fades. Performance lags, doubt creeps in. You start comparing, you start justifying. Nothing is broken, but something shifts. And once it does, the decision is already made. There's one factor you're not accounting for. Without it, patience collapses exactly when it's required most. Let's start with what you already believe. You believe lower fees mean higher returns. You believe 0 is better than anything above 0. You believe the rational move is to minimize cost and let compounding do the rest. That belief is technically correct. It's also the reason most people holding 0 funds underperform the market they're trying to track. Here's the part no one talks about. Expense ratios don't predict investor behavior, and investor behavior destroys more wealth than fees ever will. Morningstar ran a study on investor returns versus fund returns. The average equity fund returned 9.1% annually over a 10-year period. The average investor in those same funds earned 7.3%. The difference? Timing, exits, emotional decisions. The fund did fine. The investor did not. 0 funds attract a specific type of investor, cost-conscious, analytical, skeptical of fees. That sounds like a strength. It's actually a vulnerability, because when you choose a fund purely based on cost, you have no other reason to stay. There's no brand loyalty, no advisor keeping you accountable, no friction between you and the sell button. You're one bad quarter away from convincing yourself you made a mistake. Let's talk about what happens in year 2. You buy FZRO in January. The S&P 500 is up. You're up. Everything feels correct. Then June hits. The market drops 8%. FZRO drops 8.2%. You check your account. You're down more than the index you're trying to track. Not by much, maybe 40 basis points, but you notice. And that noticing starts a process. You begin checking performance daily. You compare FZRO to VOO, to SPY, to every S&P 500 fund you didn't buy. You see VOO recovering faster. You see SPY getting more inflows. You see articles praising Vanguard's dominance. You start wondering if 0 fees are worth it if the fund can't keep up. You tell yourself you're being rational. You're just gathering data. But what you're actually doing is building a case to quit. This is loss aversion in action. Losses hurt twice as much as gains feel good. You didn't feel twice as happy when FZRO matched the index, but you feel twice as upset now that it's lagging by 0.5%. Your brain isn't wired to ignore that gap. It's wired to interpret it as a threat. Here's where it gets worse. FZRO doesn't trade on an exchange. You can't see real-time pricing. You can't sell instantly during market hours. That sounds like a disadvantage. For long-term investors, it's actually protection. But you don't feel protected. You feel trapped. You feel like you're holding a fund that moves slower, reports later, and gives you less control. Meanwhile, VOO is right there, liquid, instant, tradable. The illusion of control starts to feel like actual control. Now add comparison. You're in an investment subreddit. Someone posts their VOO returns, clean, simple, beating FZRO by 0.6% over 6 months. You comment asking if the difference matters long-term. 3 people reply telling you FZRO is fine, but they switched to VOO for liquidity. No one switched back. That plants a seed. You start thinking, if everyone's moving to VOO, maybe I'm missing something. Let's talk about boredom. This might be the most underrated force in investing. You didn't buy FZRO to get rich slowly. You bought it because it made sense, because the logic was airtight. But 6 months in, nothing is happening. The balance goes up a little, down a little, sideways. There's no story, no narrative, no reason to check your account. And that boredom makes you vulnerable.
Because while you're bored, someone on YouTube is making 40% trading Tesla options. Someone else is posting about how they 10x their portfolio with a leveraged ETF. Someone else is explaining why the S&P 500 is dead and small caps are the move. You know better. You know those are exceptions, survivorship bias, noise. But knowing doesn't make you immune. It just makes the boredom harder to tolerate. Here's what happens next. You start researching alternatives, not to switch, just to understand your options. You read about sector ETFs, dividend funds, international diversification. You convince yourself you're learning, but what you're actually doing is creating optionality. And optionality is the enemy of commitment. The moment you believe there's a better fund out there, you're already halfway out the door. You'll wait for a reason, a dip, a headline, a bad month, and the market will give you that reason. It always does. Now, let's talk about the investors who stay. They're not smarter, they're not more disciplined, they just have a different relationship with the fund. Some bought VOO because their advisor recommended it. There's friction in firing an advisor. Some bought through a 401k with limited options. There's friction in changing allocations. Some bought because Vanguard feels like a brand that won't disappear. There's emotional safety and legacy. None of those reasons are rational, but they work. FZROX has none of that. No advisor relationship, no employer plan, no 70-year track record. It's a product, a good product, but just a product. And products are easy to replace. Here's the uncomfortable truth. The best investment isn't the one with the lowest fee. It's the one you'll actually hold. If FZROX saves you 3 basis points a year, but you sell after 18 months, you lose. If VOO costs you 3 basis points, but you hold for 30 years, you win. The math doesn't care about your intentions. It only cares about your behavior. So, why do people still choose FZROX? Because the pitch is perfect. 0 fees, broad diversification, Fidelity's backing. It feels like the smart move. And it is, on paper. But investing doesn't happen on paper. It happens in your checking account at 11 p.m. when the market's down, and you're wondering if you should have bought something else. It happens when your coworker mentions their returns, and yours are lower. It happens when you're bored and Reddit convinces you there's a better strategy. The fund you choose matters less than the reasons you chose it. If you picked FZROX because it's free, that's not a reason to stay. That's just a reason you haven't left yet. Here's what no one tells you. The investors who win long-term don't have better funds. They have better stories. They know why they bought, they know what they're waiting for, they know what would make them sell. And the expense ratio went up isn't on that list. You need to answer one question before you choose. Not which fund is cheaper, not which fund tracks better, but which fund will you still be holding when the market tests you? Because it will test you. It will drop 30% and recover without you. It will underperform for 2 years straight and then double. It will bore you until you're convinced you're wasting time. The fund that survives that test isn't always the best fund. It's the fund you can't talk yourself out of. And here's the problem. You don't know which one that is yet. You won't know until you're losing money and nothing makes sense and every YouTube video is telling you to sell. That's when you'll find out if 0 fees were enough, or if you needed something else to hold on to. If this is making sense, hit the like button. It helps more people find this before they make a choice they can't take back. Let's talk about what actually happens between year 3 and year 10. This is the period no one prepares you for because nothing dramatic happens. The market doesn't crash and recover like a movie plot. It just grinds, sideways, slightly up, slightly down. Your balance grows so slowly you can't see it month to month. You check your account in January, then again in June. The difference is negligible. This is where most people break. Not because they're losing money, because they're not winning fast enough. Here's the shift that changes everything. Investing doesn't reward you for starting. It rewards you for staying. And staying means surviving the years where nothing proves you right. You need to understand how compounding actually works, not the math, the experience. In year 1, you invest $10,000. It grows to $10,800. You made $800. That feels like nothing, because it is nothing. You can't buy anything meaningful with $800. It doesn't change your life, so your brain files it under not working yet. Year 2, your balance grows to $11,600. You made another $800. Same result, same feeling. Except now you've been invested for 2 years and you're only up $1,600 total. That's not wealth. That's barely a vacation.
your brain starts whispering, this isn't worth it. Year 5, you're at $14,600. You've made $4,600 over 5 years. That's less than $1,000 a year. You could have made more working weekends. This is the moment most people quit. Not because the fund failed, because the feedback loop is too slow for the human brain to tolerate. But here's what you don't see. Year 6, your balance hits $15,700. Year 7, $17,000. Year 10, $21,600. Now you're making $2,000 a year without doing anything. That's more than you made in the first 5 years combined. Year 15, your balance is $31,000. Year 20, $46,000. Year 30, $107,000. You invested $10,000 once. Now you have $100,000. That's not luck, that's survival. Here's the part that breaks people. The first 10 years feel like nothing is happening. The second 10 years feel like you're finally getting somewhere. The third 10 years feel like magic. But you only get to year 30 if you survive year 7. And year 7 feels like the dumbest year of your life.
This is why FZROX versus VOO doesn't matter the way you think it does. The difference in returns between those funds over 30 years might be 2% total. 2%. But the difference between holding for 30 years and quitting at year 6 is $80,000. That's not a rounding error. That's your retirement. Let's reframe what boredom actually means. When your portfolio is boring, that's not a bug. That's proof the system is working. Exciting portfolios are exciting because they're volatile. They move fast. They create stories. They give you something to talk about. But volatility is expensive. Every big move up is followed by a big move down, and every big move down is an opportunity for you to panic and sell. Boring portfolios don't give you that opportunity. They just sit there, compounding, quietly. No drama, no narrative, no reason to check your phone. That boredom is friction, and friction protects you from yourself. Think about the investor who bought VOO in 2015. They watched it go up in 2016, down in 2018, up in 2019, crash in 2020, rocket in 2021, drop in 2022, recover in 2023. Every single one of those moves felt important. Every one created a decision point. Should I sell? Should I buy more? Should I switch to something safer? None of those decisions mattered. The only decision that mattered was staying in. Now think about the investor who bought FZROX and forgot their password. They couldn't check daily. They couldn't trade during market hours. They couldn't panic sell at the bottom. They just stayed in. Not because they were disciplined, because they had no other option. 10 years later, they have the same return. Maybe slightly less, maybe slightly more, but they have it. Here's the insight that changes everything. The best investors aren't the ones who make the best decisions. They're the ones who make the fewest decisions. Every time you touch your portfolio, you risk breaking something. Every time you switch funds, you reset the clock. Every time you sell and wait for a better entry point, you miss the recovery. Morningstar studied this. They looked at investors who traded frequently versus investors who set it and forgot it. The active traders underperformed by an average of 1.5% per year. That doesn't sound like much. Over 30 years, that's the difference between $400,000 and $600,000. You gave up $200,000 because you couldn't sit still. Let's talk about the investors who actually make it to year 30. They're not geniuses, they're not market experts. Most of them couldn't tell you the difference between a mutual fund and an ETF. But they all have one thing in common. They bought once and never had a reason to sell. Some of them bought through a 401k and never looked at the allocation. Some bought on their advisor's recommendation and trusted the process. Some bought VOO because it was the first result on Google and didn't know there were alternatives. None of those are good reasons, but they worked because the best reason to stay invested is not having a reason to leave. This is why the question isn't FZROX versus VOO. The question is, what will keep you in when your brain is screaming to get out? For some people, that's zero fees, the logical purity of paying nothing. For others, it's liquidity, the control of being able to sell anytime.
For others, it's legacy, the comfort of a brand that's been around since 1975. None of those reasons affect long-term returns, but they all affect whether you'll be around to collect those returns. Here's the test. Imagine it's 2026. The market drops 22% in 3 months. Your portfolio is down $15,000. Every headline is predicting a recession. Every expert is saying this time is different. Your coworkers sold everything and moved to cash. They feel smart. You're still holding. What's the reason you don't sell? If your answer is because the expense ratio is 0, that's not enough. If your answer is because I don't have a better option, that might be enough. If your answer is because I knew this would happen and I planned for it, that's enough. The fund you choose should match the reason you'll stay. If you value logic and cost efficiency, FZROX works. If you value liquidity and control, VOO works. If you value simplicity and legacy, SPY works. They all get you to the same place. The question is which story you can live with for 30 years. Let's resolve the original question. Which one really wins long term? The answer is neither, because the fund doesn't win, the investor wins. And the investor who wins is the one who's still holding when everyone else quit. FZROX will not make you richer than VOO. VOO will not make you richer than FZROX. The difference in performance over 3 decades will be noise, maybe 1%, maybe less. But the difference between holding for 3 decades and quitting after 5 years is everything. That's your house, your retirement, your freedom. Here's what you need to accept. Investing will feel like a mistake for the first 10 years. It will feel slow, boring, inefficient. You will watch other people make more money faster doing dumber things. You will question whether you're wasting time. That feeling is not a signal to quit. It's a signal that you're doing it right. Because the strategy that works long-term is the strategy that feels wrong short-term. Holding through a crash feels wrong, but it works. Ignoring your portfolio for a year feels wrong, but it works. Buying the same boring fund every month feels wrong, but it works. The discomfort is the price of admission. Let me give you a different way to think about this. Investing is not a strategy game. It's an endurance game. The winner is not the person who picks the best fund. The winner is the person who's still playing when the game ends. And here's the part no one tells you. Most people quit before they realize the game was working. They quit at year 6 when they're up 30%, because 30% over 6 years feels like nothing. They don't stay for year 25 when they're up 400%, because they didn't believe it would get there.
The market doesn't reward belief. It rewards presence. You don't have to believe it's going to work. You just have to still be there when it does. So here's your job. Pick the fund you can't talk yourself out of. Write down why you bought it. Not the fees, not the performance, the reason. The reason you'll remember when you're down 20% and your hands are shaking. Then do nothing. Don't check it daily. Don't compare it to other funds. Don't switch when it underperforms for 6 months. Just let it sit. Let it compound. Let it bore you. Let it prove you wrong about how long this takes. Because 30 years from now, you won't remember the expense ratio. You won't remember whether you bought FZROX or VOO. You'll only remember whether you stayed holding. The investors who win are not the smartest. They're the most forgettable. They bought once, they held forever, then disappeared. No strategy, no trades, no story, just time. That's the answer. FZROX versus VOO doesn't matter. What matters is whether you'll still be holding either one when it finally pays off. If this changed how you think about investing, do me a favor, hit the like button. Leave a comment with the fund you're holding and why you're not switching. And if you want more videos that cut through the noise and focus on what actually matters, subscribe, because the next one's going to challenge something else you think you know. See you in the next one.